So let me ask you something. What if one of the smartest habits you think you have is actually the one making you poorer? Today we're going to dig into the daily portfolio check. You know, that thing you do. And we're going to see why this seemingly responsible action might just be the biggest threat to your long-term wealth.
I know, this sounds completely backward, doesn't it? I mean, we're told to be engaged, to be on top of our finances, but what if all that constant checking is really just self-sabotage? Let's unpack the psychology here, because it turns out looking away might be the smartest financial move you can make.
And this really is the paradox of the quote-unquote smart investor. We think checking our portfolio constantly is being diligent. It feels responsible, right? But what the research actually shows us is that too much information, it doesn't lead to better decisions. No, it leads to emotional ones that can completely derail your financial future.
And this is the absolute core of the problem. Every single time you open that app, you are jumping on an emotional roller coaster. You see a flash of red, and boom, fear kicks in. You see a sea of green, and here comes the greed. It makes you feel like you have to do something, sell, buy, just tinker. And every one of those impulsive clicks interrupts the beautiful, powerful magic of compounding, that engine where your money starts making its own money, quietly building your wealth.
So why are we like this? Why do we react this way? Well, it's not some personal flaw, it's not just you. It's actually just how our brains are wired. So let's get into the science of it, which comes from this fascinating field called behavioral finance. It explains exactly what's happening inside your head on those crazy, volatile market days.
It really all boils down to this incredibly powerful psychological quirk called loss aversion. Basically, our brains are hardwired to feel the pain of a loss about twice as much as the joy of an equal gain. I mean, just think about that for a second. Losing $1,000 hurts twice as bad as gaining $1,000 feels good. This simple little imbalance has massive consequences for your investment decisions.
And this chart illustrates that point perfectly. Just look at it. The bar for the pain of a loss absolutely dwarfs the one for the joy of a gain. Now, when you check your portfolio every day, the market is going to have down days. That's just what it does. So you're constantly exposing yourself to these small but psychologically really painful events, which makes your brain register a threat even when it's just normal, everyday market noise.
Okay, so this isn't just some fun psychology factoid. This bias, it has a real tangible cost. Let's take a look at what actually happens when this fear-driven impulse takes over and there's real money on the line.
Just think back to early 2020. Remember that? The market absolutely plunged. And for all those daily checkers, that feeling of loss aversion was just overwhelming. So what did they do? They panic sold right at the bottom, turning what was a temporary paper loss into a permanent, very painful one. And then what happened? Well, they had to watch from the sidelines as one of the fastest, most powerful market rebounds we've ever seen took off without them. Ouch. So here's the crucial point. Checking daily is like putting market volatility under a magnifying glass. You're just amplifying all that negative noise and giving that loss aversion part of your brain a hair trigger sensitivity. It dramatically increases the odds that you'll do exactly the wrong thing at exactly the wrong time. All right, so we have totally diagnosed the problem. Now, what's the solution? What do we do about it? Well, thankfully, it's surprisingly simple. It's all about changing your perspective. It's about learning the incredible power of just zooming out. And just look at the difference here. I mean, it's night and day. On a daily or a weekly basis, the market is just chaotic noise. It's up, it's down, it's stressful. But when you zoom way out and you look at the trend over decades, all that noise just kind of fades into the background. And what you see is a clear, powerful upward trend. That is the picture you need to keep in your mind, not the daily squiggles on the chart.
So how do you actually put this into practice? Well, it's a pretty simple three-part discipline. First, and this is the hardest part for most people, just check less. Put it on your calendar, make it a quarterly thing, or hey, even an annual event. Second, when you do check in, ignore all the noise. Just ask yourself one question. Am I still on track for my long-term goals? And finally, just make sure your investment mix still makes sense for you. That's it. You're shifting from a state of panic to having a process.
And when you start to implement this new strategy, it leads to a really fundamental shift in how you see yourself as an investor. You're going to move away from being this active, anxious watcher to becoming a patient, confident owner.
Look, at the end of the day, your job is not to be a market timer. It's not to be a financial wizard who reacts to every single piece of news. Your real job is to build a solid plan and then get out of the way.
You have to let that incredible engine of compounding do its work over years and decades, without you constantly jumping in and interrupting it with emotional decisions.
So I'll leave you with this to think about. We spend so much time and energy worrying about the market, worrying about inflation, about the next recession, but what if the single greatest risk to your portfolio isn't out there at all? What if it's sitting right here, in your own reaction to it? Remember that, the next time your thumb hovers over that app.